What's up, everyone? Welcome back to High Dividend Explorer. Today, we're breaking down a unique way to generate passive income, one that can help you achieve financial freedom faster, especially if you're an income-oriented investor. We're talking about covered call ETFs. By the end of this video, you'll know the difference between investing in traditional stocks with standard dividend yields and a high-yield covered call strategy that could get you closer to your financial goals sooner than you'd think. If you've been dreaming of living off investment income without touching your principal, or you're looking for a way to retire early and truly take back control of your time, stick around. Trust me, you don't want to miss this. And hey, if you like videos that break down investing strategies to help you gain financial freedom faster, make sure to hit that like button and subscribe to stay tuned for more content. Now let's jump in. All right, let's start with the basics. If you're new to investing, you might have heard of dividends. Think of dividends as a reward from a company just for holding their stock. When you buy shares of a company, you're actually buying a piece of that business. So if the business is profitable, it may decide to share some of those profits with shareholders, and that's where dividends come in. Dividends are usually paid quarterly, which means you could be seeing cash flow 4 times a year just for holding onto the stock. Here's how it works. Say you own a stock that trades at $100 per share, and it pays out $5 in dividends per share annually. This would give you a 5% yield, meaning if you invested $1,000 in this stock, you'd get $50 a year just in dividends. But not all stocks pay dividends. Dividend-paying stocks tend to be more mature, stable companies that focus on cash flow. So what does this mean for an investor? Dividend stocks provide a steady, predictable cash flow, even when stock prices fluctuate. However, the average dividend yield across the market is around 2 to 3%. This is why some investors, especially those looking to boost their income, turn to strategies like covered call ETFs, which I'll dive into now. A covered call ETF like XDTE is a type of fund designed to maximize income by using a specific option strategy. For those who might be new to options, let's break it down. A covered call is a strategy where the fund owns stocks, like the companies within the S&P 500, and sells call options on these holdings. This means that the ETF collects income by essentially renting out the potential gains of its stocks for a fee, which is then distributed to investors as dividends. XDTE is a fund that invests in the S&P 500, the 500 largest, most established companies in the U.S., meaning it's tied to the broader market and inherently diversified. But because of its covered call strategy, XDTE can generate yields of around 18%, far exceeding the typical 2 to 3% you'd see in most stock dividends. So how does this compare to traditional dividend investing? Let's look at some real numbers so you can see how much income covered call ETFs could generate. Let's start by imagining you have $100,000 to invest. In a traditional dividend stock with a 3% yield, you'd be looking at an income of around $3,000 a year. Now, if you invested that same $100,000 in XDTE with its approximate 18% yield, you'd make about $18,000 a year. That's a massive difference, especially if you're relying on these investments to cover your living expenses. Let's take this example further. With a larger portfolio, say $500,000 invested in XDTE, you'd be looking at an annual income of $90,000. This amount is significant, especially when you consider that the median household income in the United States is around $70,000. For some, this could mean reaching financial independence faster than with traditional dividend stocks alone. But why such high yields? The answer is the covered call strategy, which generates income from option premiums in addition to the stock dividends, resulting in a much higher payout for investors. So if you're focused on cash flow and income now rather than growth, covered call ETFs are a powerful tool. It's important to understand exactly how covered call ETFs work because they come with both benefits and limitations. When a covered call ETF, like XDTE, sells a call option, it's essentially selling the right for someone else to buy the stock in the ETF at a set price within a specific time frame. In exchange, XDTE receives a premium for each option it sells. These premiums are then passed on to investors as part of the ETF's high yield. While this boosts income, it also caps potential gains. For example, if the stock price in the fund skyrockets, XDTE might miss out on those gains because it sold the right to those profits. So while covered call ETFs are great for consistent income, they may not capture the full market upside during bull runs. However, they do tend to outperform when markets are flat or declining, since the premium income can help offset some of those losses. This feature makes them attractive for income-focused investors who prioritize cash flow over capital gains. Now let's talk about risk. Even though XDTE is based on the S&P 500, which gives you exposure to 500 diverse companies, covered call ETFs can still face price fluctuations. And remember, since covered call ETFs are focused on income, they may underperform compared to traditional stock ETFs during strong market upswings. That's why it's essential to think of covered call ETFs as one part of a diversified portfolio rather than putting all your money into them. It's like having different streams of income. You want that balance to manage risk. This strategy allows you to maximize income while keeping your overall investment safe. Let's talk taxes, which is crucial to any investing strategy. Covered call ETFs are generally less tax efficient than traditional growth stocks or tax-advantaged accounts. Income from covered call ETFs is taxed as soon as you receive it, and depending on where you live and your tax bracket, this could mean a tax bill of 20% or more. Also, some income is taxed at the higher ordinary income rate rather than the capital gains rate. However, if you're retired or in a lower tax bracket, these ETFs could be advantageous since the income tax could be relatively low. And of course, you can consider holding these in a tax-advantaged account, like an IRA, to reduce tax exposure. So who exactly should consider investing in covered call ETFs? Well, if you're someone looking for steady income, a covered call ETF might be for you. Maybe you're close to retirement, or you want to supplement your income while keeping the principal intact. However, if your goal is maximum long-term growth, you might consider a more balanced approach, combining traditional stocks with high-yield investments to meet your needs. Also, remember that investing is deeply personal, and it's always wise to speak to a financial professional to tailor a plan for you. No one investment fits all, and it's essential to choose the one that aligns with your objectives. If you enjoyed this breakdown and want more insights on achieving financial freedom through high dividend investments, make sure to subscribe and hit that bell notification. We're here to explore the best income-generating strategies so you can take back control of your time. Until next time, stay informed, stay invested, and keep exploring those dividends.